Well, another Fed week is upon us. The Federal Reserve is expected to cut rates by 25 basis points when they come out of their December FOMC meeting on Wednesday. So this will actually make it 175 basis points of cuts. So 1.75% cuts since they started cutting rates back in September of last year. The question is, how much further do they go from here? This cut is already pretty widely expected, so it's not going to surprise too many people. But this is still a really interesting meeting. It is this quarterly meeting that we get the summary of economic projections, where the Fed produces its forecast for where they expect GDP growth, inflation, the unemployment rate, and ultimately policy rates to go over the next few years. So this is still going to be a very important meeting for us. It's important for a few other reasons. This is actually one of the 4 remaining meetings that current Fed Chair Jay Powell will be sitting in on. His term as Fed Chair expires in May of next year, and so he only has a few more of these meetings. This is assuming he doesn't stay on as a governor following the end of his term. But he only has a few of these meetings left to really help to shape the course of monetary policy. So this is going to be important. As always, we're going to be following really closely when he addresses reporters in the press conference that follows on Wednesday. Another reason this is important is with the end of Fed Chair Jerome Powell's term quickly approaching, there's a lot of talk about who will ultimately take his place. The current betting odds are showing a tilt towards Kevin Hassett. He's the current head of the National Economic Council within President Trump's administration. So he's the odds-on favorite right now. But we did see, I believe it was last week, that President Trump said that he'd actually wait probably until January to make a formal announcement. Currently, all odds are pointing towards Kevin Hassett. Some are thinking that he's still trying to get Treasury Secretary Scott Bessent to take the job. So we will see. But either way, no matter who is at the helm of the Fed when Jay Powell's term expires next May, it's going to be really, really important because, as always, they are really helping to shape economic policy in the U.S. And this comes at a really interesting time when we see that, sure, we're seeing some labor market softness. We've seen the unemployment rate actually rise in the last 3 months. Now, I will say that the data is a little bit stale thanks to the government shutdown. We're not going to get the most recent jobs data for the month of November until next week, but we know that the job market is not trending in the right direction. Now, on the other hand, we are seeing that inflation is still a problem. So the way that most of us measure inflation is we're looking at year-over-year change in prices, or we look at month-over-month change in price levels or annualized rates over the last few months. But let's just look at the year-over-year price level, price change. It's about 3%. So that's well north of the Fed's target of 2%. It's come down quite a bit from where it was. It used to be 9%. A few years ago, and it's been trending in the right direction, but that progress has stalled out over the last several months. And so that is going to limit the extent to which the Fed will ultimately be able to deliver more rate cuts in the future. So that is something we're watching. I say the way that most of us measure inflation because that's the way economists and a lot of investors measure inflation. Now, those that don't work in economics or investments, they tend to look at it in other ways. They're really looking at how much the basket of goods they're paying for continues to go up. So they're looking at the overall change in price levels. And if we look at that, we see that price levels are up about 25% over the last 5 years. If you actually have to go back to the early 70s to see another time when prices rose that amount in such a short amount of time. I believe if you go back to the early 70s, it actually took 7 or 8 years to see that amount of an increase in price levels. So therefore, it is not too surprising that last week we saw a new Politico poll come out that showed 46% of Americans actually think that inflation or affordability or the lack thereof is actually the worst they've seen it in their lifetime. And this is a poll that surveyed Republicans and Democrats alike. So I think that's really important. It's important because next year is a midterm election year, but it's also important because we know that inflation is still a concern for households, and we know that the Fed is going to have to pay attention to this going forward. Last thing I'll say is that we've seen the stock market continue to reach these new highs. At the same time, we've seen consumer sentiment in the US move lower. It's actually been flirting with the lows from the COVID era. And what that tells us is it's this K-shaped economy. And we always say that the economy is not the stock market and vice versa. And case in point, we know that there are many in the US who are certainly enjoying their stock portfolio moving higher, and they have the luxury of owning a home with a mortgage rate, let's say sub 4%. And there's also those have-nots, right? Those that are really struggling right now. They don't have a home. Maybe they're trying to purchase one when mortgage rates are north of 6%. They don't have as much held in stocks and seeing their net worth grow the way that those haves are. And I think that is really helping to explain this K-shaped economy that many of us have been talking about for so long. So these are some of the things that we're keeping an eye on heading into this Federal Reserve meeting and thinking about what meetings are likely to look like here in the months to come. So I'll leave it there for right now. I'm sure we'll have plenty to talk about coming out of this week's FOMC meeting when we catch up next Monday. But if you have any questions, please don't hesitate to reach out to your financial advisor.